All right, it's
We made
official.
it. We did
We did
it.
it. Here we are. This is our first official buyer seminar. I appreciate you taking some time to get on this and talk about a couple things. I know how I wanted to start things off, but is there anything that you wanted to start off by saying?
No, I'm honored to be here. For those of you that are joining us here on the video, if you have questions, please put them in the chat below, and we'll answer those questions as we get going. So yeah, let's get right to it. Excited.
Yeah, so you may have received an email with the title of this video, and a little intuitive coming from a real estate agent and a loan officer on reasons why you should not buy. But there are a couple of things that Cole and I were talking about that I think that are red flags when it comes to home ownership and things that you need to be aware of walking into what, quite frankly, is going to be one of the largest purchases that you ever make. So let's just jump into it. First and foremost, number one reason why you should not buy, especially in the environment that we're in currently, would have to be if you expect rates to come down from where they're at today. If you read any articles right now, a lot of people in the industry are hoping and expecting, they're talking with conviction that rates will come down. So my fear is that if you in fact are buying today with the full expectation that rates are going to come down, I think you're setting yourself up for disaster. So Cole, I'd love for you to share your thoughts about that.
Yep, I think there's a really important distinction that you're making, which is you can expect rates to come down, which the smart big money people seem to think is going to happen. So there's a difference between expecting rates to come down, which we do, and that being the reason for purchasing a house, right? If that is the reason for purchasing a house, that is a mistake because there are never guarantees when it comes to mortgage rates. You know, if we were having a conversation 3 years ago when we were at record low rates, the reason for record low rates was something that was not forecasted. It was something that was not on the economic calendar, and that was COVID, right? COVID made rates go down into the twos, which is something that we had never seen before. So there is always the unforeseen thing that can have an impact on the market. In fact, those are typically the things that impact the market most. They're the things that are not on the economic calendar that can't be necessary. They can be planned for, but they can't be expected. They can't be yeah, they're not something that you're like, oh, in the future this thing is going to happen, but you can plan for the worst case. So you should not be purchasing a house if you're like, hey, I'm not comfortable with what my mortgage payment is going to be.
Exactly.
But I'm going to go ahead and I'm going to get into the house because I'm going to refinance. That, like you said, is a recipe for disaster because there are no guarantees. That can be a nice hope, that can be a nice expectation, but that cannot be a reason for purchasing a house unless you are comfortable with what your mortgage payment is today. You should not buy a house.
So that's great. And so can you take it one step further? What would it look like? I got to play devil's advocate, but what would it look like for a buyer to buy now and then go ahead and say, you know what, interest rates have come down enough that it does make sense, Mr. Buyer, Mrs. Buyer, to go ahead and refinance? How low do rates actually need to come down in order for it to pencil out?
So, part of the answer to that question depends on the loan amount that you're taking out as well. Obviously, the higher that your loan amount is, the more like a drop of a quarter or half of a percent is going to have. But let's just say, generally speaking, where it starts to make sense is when rates drop by half of a percent. That's usually when it at least makes sense to be like, hey, let's take a look and analyze. Still doesn't necessarily mean that it's going to happen, but somebody with a higher mortgage balance a drop of 0.5%, that can have an impact of several hundreds of dollars. It's usually like in that $200 to $300 a month range that it starts to make sense to refi, because then you can look at it and say, okay, what's my cost of a refinance versus how long it'll take me to like recoup the monthly savings that I'm going to get. And usually you want to recoup your savings within, 2 to 3 years. The cost of a refinance, not including, like escrows, but just like title, escrow, a lender fee. It's usually around $5,000. So you want to, drop your monthly payment by around $200. You drop your payment around $200. That's $2,400 per year. And then you make back the cost of the refinance within 2 or 3 years. So yeah, it's not an exact percentage. It's more an analysis of how long does it take for you to get that money back or recoup that money. And that usually happens around the rate dropping 0.5%.
Nice. Okay. Okay. So moving on, I did want to talk about the second reason why someone should not purchase right now. And the thing that came up to my mind was do not buy a home if in fact the purchase is going to wipe you out from your all of your savings that you have saved up, and it's just going to leave you in a position where you're super vulnerable.
Yeah,
And the reason why I bring that up is because if in fact well, you're going to incur expenses. You're going to incur, so there's a down payment and then there's a closing cost, right? That does not include, the possible painting or the furniture that you need to buy or the flooring that needs to be replaced. I think where my mind was going is that what if something unexpected were to pop up? So Cole,
sure.
I know that we were talking off camera, what was something that came up for you?
Yeah, as a lender, I oftentimes say just because we can doesn't necessarily mean that you should. So there are loan programs that do not require you could have $1 left over in your bank account after closing and still qualify. Okay. Just because you can doesn't mean that you should. And that's not like some crazy loan program, by the way. That's like Fannie Mae, Freddie Mac, your normal, conventional, 3, 5%, or FHA, 3.5% down programs. If it's a single family residence, they do not require you to have reserves. So you can close escrow and have $0 in the bank. Obviously, everybody's living situation is different. Everybody's income is different. Generally, having 3 to 6 months of reserves is a good thing to have. Maybe you're comfortable with less if you've got those like really stable jobs or jobs that you can always pick up overtime. I think of firefighters, police officers, people that are like, oh, I gotta like grind it out and work some extra hours and make a few thousand extra dollars. People with stable jobs, maybe they don't need as much reserves. Teacher, government employees, right? Whereas somebody else, if you're somebody who is in a sales job where there is, market factors come into play, maybe you want to have more. Maybe you want to have 12 months. Maybe you want to have even more than that. If you're a mortgage loan officer or a real estate agent and you're headed into, high interest rate environment and low inventory market, right? So, you know, I'm your mortgage loan officer. I'm not your mom or dad. You get to make your financial decisions for yourself. I will give you advice on what I would recommend. But yes, there are unforeseen expenses that will come up, and some homes will have more than others. My first place that I bought, I haven't really had any unforeseen expenses because the place that I bought, pretty much everything had recently been updated. Whereas I had another house that was over 100 years old, and I had a $20,000 expense come up that was, I knew the house that I was buying, and I knew that there were going to be expenses that came up. But that would not be a house to purchase if you're left with $0 in the bank, right? So maybe you've got some advice here on like how you can kind of look at a house. And obviously there's no guarantees, and I know there's home warranties and those kind of things as well that can help you kind of taper those decisions on like, okay, how much should I have in the bank? Some houses are going to require more maintenance than others. So yeah, if you have $1 left in the bank after closing, you probably should not buy a house.
Yeah, agreed, agreed. And just to quickly touch on what you were saying is that I, through the inspection process, the inspector and the whole point of the inspection process is to kind of get a glimpse as to what you're getting yourself into. So in the event that the inspector says, "Hey, this roof looks bad," um, it's near its expected end of life. However, it's not leaking today, but maybe you only have 2 years. Well, gosh, if roofs aren't cheap, right? Or I mean, gosh, even a water heater. I know at my first place, the water heater went out about a year into ownership. And then, so granted, was it a roof replacement? No, but it was a $3,000 bill. I didn't know how to do a water heater, so I had to call a plumber. I had to do the whole thing, and it was like 3 grand. And thankfully, we had the money, right? But we also had a pretty significant amount of reserve set aside, and so it was a non-issue. The thing that comes up for me is that I just want to make sure that this home is just a blessing to your life. And in the event that, something so small as a water heater or maybe a leaky toilet, if it can turn into just this huge situation, it may be wise to go ahead and pump the brakes, build up those reserves like you were just saying, but also just slow down a little bit. Again, our industries, like, we're in very risky industries, like we were just talking about. But on the flip side, if you have a government job or a police firefighter, etc., those are very stable, right? Where you can crank the overtime, like Cole was just describing. But the thing is that in the event that you're putting yourself in a situation that you're going to regret, I don't want to get that phone call. I want to see this thing work out for you over for the long run. And I just don't want to get that phone call that I have to help you try to sell this house in a year from now because things have been kind of stacking up. Or you know what, let's not even talk about the house. What if the transmission goes out? you
Yeah.
know right? What if your hours are cut? I mean, gosh, like, there's so many other variables that are outside of the home that could really impact your situation. So Cole, I did want to ask you though, there are products, and again, I'm not a mortgage professional, so this is you. There are certain loans that do require reserves. Can you share what those are and how that looks like?
Yeah, so this is going to be people that maybe already own a property and then they're purchasing another. Sometimes conventional financing will require you to have reserves for the property that you're leaving. On VA, FHA, multi-unit properties. So, more than one unit if you're buying a duplex, a triplex, a fourplex, investment properties. These require you to have reserves or jumbo loans. Let's say you're buying a house, depending on the county, but somewhere in the million or north of $1 million. Those type of programs will also require you to have some reserves, just because they're more risky. And so multi-unit properties more risky. You've got a tenant that doesn't pay their portion of the rent. An investment property, you've got a tenant that doesn't pay rent. Jumbo loans, big loans that are not backed by the federal government, more risky, requires reserves. So yeah, those are the type of programs where you need to have some money, and it's usually around 6 months, just depending on what the program is and who the investor is. 6 months
Six
of
months
whatever the monthly payment is.
principal and interest. Okay.
Yeah.
Taxes, insurance. Okay, that makes sense. All right. So that's good stuff. Thanks for clarifying that. And last but not least, the third reason why I think someone should not buy, which would be a bad decision, is with the expectation that prices are going to continue to go up. So we've been on, and the other word that I use is that that's basically a different form of speculation, right? Where so many people got burned in the early 2000s during that last Great Recession, is that everyone was fully anticipating that pricing was going to continue to go up no matter what. Who would have thought that pricing was going to continue to go up even during COVID, or even while interest rates have more than doubled here in the last year and a half or so? And the thing is yes, prices have continued to go up, so which is fantastic for homeowners. What I don't want is I don't want people to get themselves in over their head. And basically it's a gamble in that, hey, I'm gonna buy this house for $600,000 and in 2 years it's gonna be worth $700,000. I'm gonna sell it. I'm gonna make a profit. And I just think that that's short-sighted and risky. And so I guess what's your thought about all that?
Yeah. This goes back to what we expect to happen versus what making a decision based off of what we expect to happen. So, you should buy a house when you are able to afford what the monthly payment is, because and not make a decision based off of what you think home values are going to do. Because here's the thing, you could have bought a house in, the very beginning of COVID, which was you got the best of both worlds, which was one, you got a home for a price before home prices blew up, right? And two, you also got a low interest rate. Okay. So this is like the best move, sometime 2020, 2021, right? Interest rates are low and home prices haven't completely like gone insane. So you get the best of both worlds. But guess what? If you were not financially, you bought a house at that time and you weren't financially ready, it doesn't matter. You lost the house. You sold the house. You or had your, God forbid, you had your house foreclosed on. So you should not be making your individual decisions based off of what you anticipate to happen, like on a macro level, like across the board, across the entire economy. Because if you're looking around and you're like, oh my gosh, rates are low, home values are about to go up, I'm going to buy a house right now, but you are not financially ready, it doesn't matter. You lost the house. Okay. On the other side of things, it doesn't like it matters, but it doesn't matter. You give me a 10% interest rate. If I am comfortable with what the monthly payment is,
Yep.
you buy the house, right? And you don't buy it with the anticipation that you're gonna sell the house in 2 or 3 years. Yeah, that's worked out for people for the past, I mean, at this point, we're going on like what, 10, 15 years of home values going up, which is, pretty wild. But both times I bought a house, I bought it, quite frankly, expecting that I was buying at the peak. The first house that I bought in 2017, I remember the real estate agent like posted like record in this, zip code or whatever. And I was like, oh man, like I overpaid for the house. Like I feel like an idiot. But I quickly told myself, hey, this is something that I'm keeping long term. And this home value could go down by 20% tomorrow. I don't care. I'm keeping this house long term. And fortunate for me, like the value has gone up significantly since I bought. Same thing in 2021. That was a time where it was like, oh, people probably forgot about this, Chris. I'm sure you remember. It was like, oh, rates are low, home values are inflated. I'm not gonna buy because when rates go up, home values are gonna go down. You remember that whole conversation that everybody was having? Like, oh, rates are low, home values are inflated. I'm not gonna buy. Every single one of those people are kicking themselves for not, purchasing then, that were financially capable of buying a house. But that's what the word out in the market was. Don't buy, rates are low, home values are inflated, rates are going to go up, and, prices are going to crash. Of course, it didn't happen, but I bought, and nobody knows what the market is going to do. I bought totally comfortable with the fact that my home could go down in value after I bought, and it hasn't. It's gone up. But I don't want to go off on too much of a tangent here, but we're here in Southern California, right? Always like to use like just this, our market is an example. But if you're watching and you're somewhere else in Northern California, I know the same thing applies, which is, nobody bought a house 30 years ago and, looks back and like, oh man, I bought in 94. I really should have waited until 97. Or, oh, I really missed the boat. I bought in 94. 91 really would have been the time that I should have bought. All of these people looking forward 30 years, they've seen massive appreciation, and they don't care. And guess what? In that period, home values went up, home values went down. The only people that are not happy are the ones that bought when they were not financially ready to buy and they had to get rid of that house. Those are the only people that regret it because they don't still own the house. So kind of a long answer to your question, but yeah, if you're looking to purchase and then see massive appreciation, it can happen. But that should not be the reason why you buy.
Yeah, yeah, I think it's a huge benefit, and like Cole just described, it's one of those things to where give it a long enough runway, it's gonna work out, and the numbers are gonna work out. Anybody that bought in the '90s, they're going like this. They're patting themselves on the back, and it is what it is. But just to expect that you're gonna make money, I think it's a dangerous situation.